A massive week ahead for the UK with the fact that we've got the Bank of England on Thursday expected to keep rates steady, but that comes in the face of an FOMC rate cut the day before, in all likeliness, and the recent ECB and Bank of Canada rate cuts. What would it take to change their mind? Well, certainly we've got the inflation data coming out of the UK just a day earlier, so it's going to be a big week, and we'll be looking out for how this could impact the likes of the FTSE 100 and the pound going forward. Here's a breakdown for market expectations as things stand. We can see inflation expected to drop down to 2%, so back down to target for headline. Is that disparity between headline and core inflation that's going to be key for the Bank of England? Certainly, unless we start to make some headway in that core number, doesn't look likely we are going to see the move this time around. In terms of the monthly metrics, both expected to be pretty decent, actually. 0.1% is indicative of an inflation rate, of course, that's just above 1%. So essentially, we're looking at headway being made, but certainly in terms of that core CPI number, it's too high. And the likeliness is that we're going to see it come down next month, but not this time around. And I'll show you exactly why. In terms of market expectations, 5% on that interest rate in the UK for the Bank of England, and there's an expectation it will keep it steady this time around and cut next month. We've also got retail sales coming out at the back end of the week on Friday. Here's the breakdown in terms of the UK inflation metric. You can see last month, minus 0.179 was the monthly figure. That helped us essentially get down to that 2%. Well, in actual fact, we saw it moving towards the upside to 2.2%. But we can see in terms of what happened last year, 0.337. That's what's dropping out this time around. So if you have that expectation within the markets, we're going to see a figure more like 0.1. That's why we get that drop off around about 0.2, and it gets us down to 2%. Now, that could grab some headlines. It could say, well, the Bank of England's work is done. But much like the Federal Reserve, with their focus on the core PCE metric, the Bank of England will also care about the core CPI, because arguably the core figure is something that, it's more aligned with the things that they're actually impacting. The Bank of England aren't in a position where they can really impact the global price of oil and fuel, or food for that matter. But they can impact many of the other things within the economy with their interest rates. And you can see at 3.29, they've still got work to do. Now, you can see from last year, the figure that's dropping out is at 0.147 for August. So in all likeliness, it's going to be very difficult for us to get much below that this time around. And so at best, we could maybe drop down to 3.2, but it's a very good chance we stay as we are. And really, the disinflation starts to kick in next month, and that 0.473 figure being stripped out. And that's why you could see a higher likeliness that actually we see the Bank of England taking steps next time, because we're probably going to see inflation on the core side down to 3% at that point. As you see at the bottom, that annualized figure, you can see over the last 6 months, that's where all the inflation has happened. You can see February through to May provided a real big uptick in terms of UK inflation. And so, yes, we could see some disinflation get back down to 3% in September, or once the September reading comes out. But then beyond that, at the back end of the year, there's going to be a lot of choppiness. We could end up moving significantly higher over the near term. But then once we come into next year, once we start seeing those figures stripped out in a meaningful manner, that's when we see the big disinflation really start to pick up. Now, in terms of the core reading, you can see from a sort of relative standpoint, it's doing something similar to what's happening over in the US, 3.3 in the UK, 3.2 in the US, also struggling. The difference is that the US has also got the core PCE metric to rely on, and that's significantly lower at 2.6. Meanwhile, the Eurozone figure 2.8%. So both the US in terms of their core PCE and the Eurozone core CPI significantly below where the UK is. And that's perhaps why we see this hesitation. In terms of average hourly earnings or average weekly earnings in the UK, you can see here this downward trajectory we're seeing in both total and excluding bonuses figures, moving towards the downside. Inflation essentially at target near enough. But we do need to see those underlying inflation pressures ease. And this is a key part of that, the cost of employment. And we're starting to see that coming down to more normal levels. You can see Prior to the pandemic, the figure was closer to sort of 3.5%. So if we can get in that kind of area, it's going to be a lot more of a comfortable position for the Bank of England. In terms of that retail sales figure on Friday, I thought it would be notable to show you this chart because I find it particularly interesting, right? What we can see here is that the UK experienced, of course, a massive surge in terms of inflation. And what happened from it? We saw higher prices leading to people paying more and receiving less. You can see the volume of goods people receiving on the slide. At the same time, people are paying more for it. So a difficult time, people trying to maintain their standards of living, paying more and ultimately having to trim back on what they're actually receiving. That appears to have changed. You can see here more recently the upward trajectory and the bottoming out in terms of volume, serving to highlight the fact that essentially we're now back on a more normalized trajectory where you see the likes of inflation not playing as significant a role. And so we see the value and the volume of retail sales both moving towards the upside, moving in lockstep. Now, in terms of the expectation for a interest rate cut from the Bank of England, you can see here we've got sort of 76% attributed to a pause and just 24% expected for a 25 basis point cut. Moving beyond that, you can see the expectation is that we see 25 basis point cuts from November onwards. So month after month, we're expecting to see cuts, but not this time around. The question mark here is whether this is going to lead us into a position where perhaps we see underperformance for the FTSE, perhaps we see strengthening for the pound. Let's just quickly go on to the chart. This is the FTSE 100. First and foremost, we can see that the trend is a bullish one since the pandemic, but we see these long periods of consolidation. We're seeing that at the moment. We're not yet at a breakout point. Now, you can also see here, if I was to show you the ratio between the FTSE 100 and the S&P 500, if it loads up, we will see that it is been very slow. We'll see essentially it's a downward trajectory over a long period of time. So we have the UK FTSE 100 that is generally an underperformer. There you go. So over this sort of post-COVID period, we did see a phase where we saw outperformance for the FTSE 100, but the long-term benefits US markets. And so I wouldn't necessarily say, I'm super bullish for the FTSE, but, I'm bearish for the US, because right now that trend still does play out and it still does hold. So if we're looking for upside for equities, probably makes more sense to be looking at the US markets rather than the UK. In terms of the UK, we can at least see that we've bottomed out from, or seemingly bottomed out from, an area of support. You can see this zone of support holding once again, and we're starting to turn upwards as we head towards this interest rate decision. And so the bulls are starting to come back in charge. You can see from a sort of fib perspective, this bottoming out with a nice big deep retracement at the beginning. Then we've sort of come into a mid-sized 61.8 retracement. So we're pushing upwards. I wouldn't be surprised to see us push up and try and get back up towards the top end of this range. But as things stand, this range really does still hold, and we haven't necessarily seen that breakout. We've seen months after months of consolidation here for the FTSE 100. And certainly if it's the Bank of England that's holding off and the other central banks are easing, it's probably more reason for people to be looking elsewhere. In terms of, that's the VIX, we don't want to look at that. In terms of the pound, we could see some upside in terms of the idea that we're going to see them holding off. But I think any upside is likely to be short-term in nature when you're looking against something like the Japanese yen. You can see here sterling yen, a really nice trend at the moment. We're starting to roll over once again. In terms of support, you're going to be looking out for this near-term support here. So, possibly if we see the Bank of England holding off and they hold a relatively hawkish stance, you could see a near-term pop, but near-term rallies are likely to be sold into as we see this Japanese strength really coming through at the moment. It is a big outperformer at the moment. So when we're looking for trends, you can see the past couple of weeks really have been dominated by weakness for sterling yen, and therefore any near-term pop around, possibly this pausing for one more meeting could provide us with a short-term rebound that gets sold into as people really focus on that recovery play for the Japanese yen after a protracted multi-year period of weakening that has taken place against the Japanese yen. That trend certainly reversing in pretty dramatic fashion over the course of the past month and a bit.